Welcome back to the Deep Dive. Today, we are getting comfortable and diving into the business of comfort itself.
We are. We're looking at La-Z-Boy Incorporated, ticker LZB, and their Q2 2026 earnings call.
Right. And this is one of those iconic brands everyone knows, but what's fascinating is they're using this, uncertain market as a launch pad, not a pause button.
Exactly. This isn't just about the quarterly numbers. We're looking at the opening remarks from CEO Melinda Whittington, and she lays out this huge strategic pivot. They call it the Century Vision.
And our mission today is to figure out how a company this big tries to pull off a reset of this scale while, in her own words, navigating a choppy market.
Yeah, that's the real story here.
So she starts off saying they had solid results, which, can mean anything.
Right. It's standard corporate speak.
Yeah.
But the tension is that despite this choppy environment, they claim they're creating their own momentum.
Okay, so let's put some numbers to that. She reported total delivered sales for Q2 were $522 million.
Which is up slightly from last year. But you're right, delivered sales are only like half the story here.
So what's the other half?
Well, it's the cash. The cash position is what really gives them the confidence for this massive shift. They generated a stunning $50 million in operating cash flow.
$50 million.
Yeah.
In one quarter. How does that stack up against last year?
It's triple.
Triple.
Triple the comparable period last year. I mean, that kind of cash flow lets you do aggressive things. It lets you invest and, disrupt your own model.
And to really hammer that point home.
She announced a 10% increase in their dividend. That's the 5th consecutive year of a double-digit hike. When you can do that, you've earned the right to make some big, risky moves.
Okay, so they have the financial muscle. Let's talk about the retail reality check. What was actual consumer demand like?
So this is where we have to get into the weeds a little bit between different kinds of sales metrics.
Right. She talked about delivered sales being up slightly, but she spent more time on written sales.
Yes. And it's an important distinction for you to understand if you follow retail.
So break it down for us. Written versus delivered.
It's pretty simple, really. Delivered sales are what they actually shipped and got paid for. That's the revenue that hits the books. Written sales are the new orders they took.
So written sales are the forward-looking indicator, what people are buying right now.
Exactly. It's the best measure of current customer demand. And she said total written sales in their retail segment were up 4%.
Okay, 4% sounds pretty good.
It does, but that was driven mostly by new stores they opened or acquired.
So if we strip that out, what was the underlying trend? What about the stores that have been open for a while?
That's the key question. And written same-store sales, so sales from locations open for at least a year, they were actually down 2% for the quarter.
Down 2%. That's the headwind she was talking about.
That's the headwind. But, and this is the crucial point she made, it's about the sequential story, the trend line.
And what's that story?
It shows they're agile. She highlighted that they've seen sequential improvement over the last 2 quarters. In this kind of tough, high-interest rate environment, the trend is your friend. And in October, they actually hit positive.
Positive same-store sales in this climate.
For October, yes. It's a big deal. It suggests they're either stealing market share or their new strategies are actually starting to work.
But she was still pretty cautious, wasn't she?
Oh, extremely. She immediately threw some cold water on it, saying that while October was strong, early November was mixed. So, they're navigating this week by week.
And what about Joybird? That's their more modern direct-to-consumer brand.
Joybird showed significant improvement. Total written sales were up 1% versus a year ago.
Which is a real turnaround from where they've been.
A huge turnaround. And what's interesting is that this was driven by the strength of their physical retail stores, not just online.
So even the digitally native brand is finding success in brick and mortar.
Absolutely. They just opened their 15th Joybird store in Columbus, Ohio. And this all ties back to their main strategic bet.
Which is
focusing everything on their core, vertically integrated North American upholstery business.
And speaking of that focus, let's talk about the big headline-grabbing move, the acquisition.
This was a landmark deal for them. They bought out a 15-store independent dealer network in the Southeast.
In places like Atlanta, Orlando, Jacksonville.
Yep, high-growth markets. She actually called it the largest independent store acquisition in the company's history.
And what does a deal like that add to the top line?
It's expected to add about $80 million in annual retail sales. Now, that nets out to about $40 million for the total company, but it's immediately accretive.
Meaning it adds to sales and profit right away.
right now. It's like they're buying revenue to help fund all the disruption they're causing elsewhere in the business.
So they're buying up successful stores and building new ones at the same time.
At a record pace. She said they opened 5 new company-owned stores this quarter alone, 15 new stores in the last 12 months.
Wow.
She called it the most significant period of new retail store growth in the company's history. It's not just about adding stores, though. It's about changing who controls the network.
What do you mean?
Well, just 5 years ago, company-owned stores were about 45% of their network.
Okay.
Now, with this big acquisition, company-owned stores make up 60% of their current 370 store network.
60%. So they're taking direct control of the customer experience.
Immense control over pricing, inventory, branding, everything. They're shifting from being a manufacturer to a true vertically integrated retailer.
Which leads us right to the other side of that coin, portfolio optimization. If you focus this hard on one thing, other things have to go.
And they're being aggressive about it. The CEO detailed plans to exit several non-core wholesale businesses. Kincaid Case Goods, American Drew Case Goods.
Oh, you've said case goods a couple of times.
Yep.
For anyone listening, what exactly is that?
Case goods is just the industry term for non-upholstered furniture. Think wooden desks, dressers, dining tables, hard surfaces.
So they're getting out of the business of making wood furniture to focus entirely on their core strength, which is sofas and chairs.
Precisely. It's about allocating capital where they have a real advantage. They can still sell a dining table in their store, but they'll source it from someone else instead of manufacturing it themselves.
That makes sense. And what else is on the chopping block?
They also proposed closing their manufacturing facility in the UK.
Shifting to, and I'm quoting here, more financially sustainable sourcing alternatives.
It really looks like they're doubling down on North America and just simplifying their global footprint.
And the timeline for all this seems incredibly fast.
It's remarkable. She said they expect all these exits and strategic actions to be substantially completed by the end of our fiscal year.
That is an insane pace for this level of operational change.
It is. It means a total internal realignment, which she touched on too. Shifting around senior leadership, corporate staffing, you have to support a model this streamlined.
So even with 60% of stores being company-owned, they still need a strong wholesale business for the other 40% and for other retailers.
Absolutely. They can't just rely on their own stores. So the final piece of the strategy is enhancing that wholesale channel.
And they announced some big new partners.
3 huge ones. First, Living Spaces, a top 100 retailer with a big presence out west.
Okay.
Second, Costco. They launch products not just online, but on the floors of over 350 Costco locations.
That's massive for visibility.
Huge. And finally, Farmers Home Furniture, which adds over 260 stores across the Southeast.
So it's a two-pronged strategy. Use their own stores for deep, controlled engagement, and use these big partners for broad reach and volume.
It's highly complementary, yeah. And all this is happening while their rebranding seems to be working. She quoted a headline, "How La-Z-Boy made comfort cool again."
So they're finally resonating with millennials and Gen X.
It seems so, which they absolutely need for long-term growth.
Okay, let's talk about the engine under the hood, the thing that makes all of this possible, the supply chain transformation.
This is foundational, and the numbers here are just wild. They are radically shrinking their distribution footprint from 15 large distribution centers down to 3.
15 down to 3.
15 down to 3 centralized hubs. I mean, just think about the complexity of closing 12 massive warehouses.
And they did 2 of those just this past quarter.
Yeah.
So what are the tangible benefits of a move that drastic?
Well, it hits everywhere. They expect a 30% reduction in warehouse square footage, a 20% reduction in the mileage inventory has to travel.
Less time on trucks, less fuel, less costs.
Right. But here's the part that you, as a customer, will feel. They are doubling their delivery radius from those 3 hubs.
Doubling. From what to what?
From 75 miles out to 150 miles.
Wow. So from just 3 locations, they can serve a much larger chunk of the country and probably do it faster and more efficiently.
Much more efficiently. And the financial payoff is where it gets really interesting.
Okay, let's hear it.
This transformation, once it's all done, is expected to deliver 50 to 75 basis points of wholesale segment margin improvement.
All right, let's pause on basis points.
Yeah.
For anyone who doesn't live in finance, what does that actually mean?
A basis point is just 1/100%. So 50 basis points is half a percentage point.
So they're boosting their wholesale profit margin by 0.5% to 0.75% just from being more efficient.
Exactly. It's pure profit they're creating through operational excellence, not by raising prices. And that contributes up to 0.5% on the total company margin.
So this all ties back to that century vision she mentioned at the start.
It's the perfect summary. All these moves, the acquisitions, the exits, the supply chain overhaul, it's all designed to sharpen their focus on the core business where they have, and I quote, a leadership position and a right to win.
So growing double the market and hitting double-digit operating margins. That's the long-term goal.
That's the goal. They're trading all this short-term complexity and pain for long-term control, efficiency, and market dominance.
So if you put it all together, buying 15 stores, closing down entire manufacturing lines, consolidating 12 distribution centers, this is a company in the middle of a massive, aggressive internal rebuild.
They're tearing it down and building it back up, absolutely.
So here's the final thought for you to chew on. With all this strategic pivoting going on behind the scenes, what specific measurable difference should you, the average consumer, expect to see in the next year or so? I mean, is this all just for higher profits? Or will it fundamentally change the experience of buying a La Z-Boy?
Well, the customer has to feel it, or the whole strategy is a failure. The most measurable difference should be speed and consistency. By taking over the best stores and building this hyper-efficient distribution network, your custom-ordered sofa should arrive significantly faster and with far fewer mistakes. The margin improvement, all those basis points, that's the financial reward they get for creating a better, more predictable customer experience. The goal isn't just to be known for comfort anymore. It's to be known for delivering that comfort faster and more reliably than anyone else.